Good afternoon, ladies and gentlemen. Welcome to this last panel session. I have the pleasure to chair this very interesting panel of experts. And we have a topic, monetary policy beyond normalization. And one can say that after a long period of unprecedented monetary policy actions, that with a host of new monetary policy tools, that central banks are now striving to get back to normal. The question, of course, is what is normal, and don't we have a new normal? Jan Smets this morning touched already upon a few of the issues. For example, what about quantitative easing, balance sheet management? A few years ago, Janet Yellen already claimed that QE would be part of the normal toolbox of central banks. Will this also be the case in Europe? Something to be discussed. Secondly, what about targets? Can banks revert or maintain their old policy targets with the knowledge we have gained during the crisis? For example, there have been suggestions, remember, by Olivier Blanchard and others to raise inflation targets to 4% to avoid periods of deflation. Then there's the question about to what extent central banks should focus only on inflation and to a lesser extent on growth. We know from the work of the late Hyman Minsky that long periods of even stable growth and inflation can lead to financial excesses. So shouldn't central banks only focus on inflation and growth or unemployment, or also take financial stability into the equation? Then there's an important issue. Some critics are saying that central banks have been crossing the line between monetary policy and fiscal policy. Now, on the other hand, there are people that are claiming that they should go even further. You have all this talk about helicopter money. Think also, for example, of new system like the Volgeld proposal in Switzerland. And finally, a question about independence. Also, it was been raised this morning already. What about central bank independence? In my humble opinion, during the crisis, central banks have definitely done at least a decent job, but there have been some complaints, and people say that, okay, this is an institution with unelected bureaucrats that wield such a big influence on the economy. Shouldn't we change the setup of the central banks and so forth? So a lot of interesting issues to be solved, and I have a panel of excellent experts. There's no question about that. We have Maria Demertzis, who is Deputy Director at Bruegel with a long experience in central bank research. We have Andrew Filardo, the Head of Monetary Policy at the BIS. There's Natacha Valla, the Deputy Director General of Monetary Policy at the ECB. And Anders Vredin, who is Head of the General Secretariat at the Swedish Riksbank. So without further ado, let me give the floor to Maria, and we have been asked to be a bit more dynamic and to stand up when presenting the intervention, so we will abide. Thank you. Maria, the floor is yours.
Thank you very much. So thank you very much for the introduction, Peter, and thank you very much to the bank and to SUERF for a very kind invitation. I'm really delighted to be here to talk about this. I'd like to talk about three things, Peter, but I'll mention two, and if I don't have time, perhaps I can come back in the discussion. Now, in thinking about an optimal monetary policy for the future, I would like to provide a little bit of context in which my comments will be given. The first one is that monetary policy, the optimal side of monetary policy, is not a general concept. If you're thinking about Europe, we have a very specific governance structure in the Eurozone, which actually merits a somewhat different approach to the way that we design monetary policy. It's important to understand that we have a very specific architecture of governance in the Eurozone, and importantly, it might even change. It has been changing in the crisis, and it might change even further. And I think that's an important source of uncertainty in trying to understand what monetary policy in that new normal ought to look like. That's my first, if you like, proviso. Then, at the same time, in my view, there are a significant amount of what we now know as the unknown unknowns, things that are really weighing in very heavily in terms of what the future would look like. And therefore, we cannot ignore designing monetary policy, the way that we design monetary policy when we think about the future. There are a number of, I have a list here, but there are a number of very big issues in my view that are weighing very heavily in the global economy and in our ability to do the macro management of which monetary policy is part of. So the issue of trade wars, for example, where are we coming from and where are we possibly going? What is that going to mean for globalization? What is going to be about the global multilateral system? And therefore for production, the integrated global chains. The EU is very heavily involved in global supply chains. If we have trade wars, that's going to affect the ability to produce and will have a number of knock-on effects. Then there is migration. If you look at the demographics in the world demographics in sub-Saharan Africa, the numbers are showing us that migration is going to be an important contributor. I don't want to say problem, because maybe it's part of also the aging problem, but it's certainly going to be an important contributor to the way that policy needs and ought to be designed in the future. And then last, and certainly not least, is technology. If you think about AI, the digital economy, we need to understand the new determinants of productivity, and we even need to understand how to measure productivity in an environment of digital technology. Now, what this means, in my view, there may be other things here. I'm just giving you a flavor of where I think the unknown unknowns are, bits that is very difficult to predict, and therefore, how do we design macro policy to fit in there? Now, therefore, I believe that it's not sensible to try and think about policies that fulfilled a very narrow set of probable events. So what do we think will happen? Design policy to cater for that. I don't think that's a sensible policy. We need to design policies, including monetary policy, that is going to be good enough for a variety of possible outcomes. That's what I mean by robust policy. And I think this is very important for all the policies, and it certainly is important for macro policy. Now, with that context then, let me go then to the 3 points that I'd like to touch off the list that Peter gave at the beginning. I will touch certainly at the first two, and if we have time, I can come back to the third, which I think also is a very important point. My colleagues will touch on others, and I hope that the discussion will have an opportunity to talk about this in greater detail. The first one is monetary policy and financial stability. Do we need to target financial imbalances? That's an important one, and one that is very different to the way that we were thinking about things prior to the 2008, the start of the global financial crisis. Do we need to increase the inflation target? Is this a better way of achieving price stability? And then finally, the tools. Are the non-conventional monetary policy tools that we now operate here to stay? Do they solve problems, or do they create more risks and problems? I think that's an important, the 3 topics to discuss. Now, concerning the first one, on targeting financial imbalances, I had done research on this issue with my colleague, Itay Agur, on this issue, and we provided a framework for thinking about an issue that now empirical evidence is verifying, is ample empirical evidence to verify it, and that is that monetary policy affects banks' risk-taking. What's interesting is that it affects bank risk-taking differently depending on whether you are on the top of the financial cycle or on the bottom of the financial cycle. So if you're at the top of the financial cycle and you reduce interest rate, that is going to increase bank risk-taking. If you're at the bottom of the financial cycle and you reduce interest rate, it will not. And that's actually what we show here, and that implies that as far as the regulator is concerned, the interest rate affects the ability of the regulator to achieve its first best. And what we show in this framework is that the regulator is unable to internalize this effect. So and therefore it's unable to neutralize this effect. And what this means is that, when you change interest rates, monetary policy is really going to throw away, or is going to affect financial stability in ways that regulators cannot correct for. So that begs the question then should probably monetary policy try and internalize this effect? In some ways, should monetary policy try and preempt this effect? It would make sense in the context of the framework that I described, where the regulator is unable to internalize this effect for a number of reasons that are details to this conversation, but they're important. The result is that. And my answer to that is probably no. I don't want to say definitively no, but I think it's probably no. And there are a number of reasons for that. The most known one is, of course, Tinbergen's one instrument, one target. If you're going to have one target for two, if you're going to have two instruments, rather two targets for one instrument, that's really going to throw off both results. That's the first one. But there are slightly more nuanced terms. So that is, again, the architecture of the Eurozone. where we find that the instruments to manage financial stability are not unique, and not all of them are equally centralized. So, you know, the ability to sort of regulate banks is one way of managing financial stability, but there are many other instruments that affect financial stability directly, and they're not necessarily equally centralized at the ECB. In my view, the nature of the problem points in the direction of a coordination solution, where you have coordination both through the instruments, those who regulate, but also between countries. That, of course, complicates things, but that is part of what I said at the very beginning, that the Eurozone isn't really, or the ECB isn't really a common central bank. It operates in a rather complicated governance structure. But what I think is crucial is not compromise the objective of monetary stability in the process of trying to regulate also financial stability. So I think that's the lesson that I've learned from this, from looking at this literature. Then, what about the inflation target? We had Peter quote the most famous conversation on this by Blanchard and co-authors. I think, in my view, in trying to answer this question, we need to look at three different things. Two are here and the one on the next slide. The first one is, well, does aiming for higher inflation avoid periods of disinflation more effectively? And I think that, in my view, it does. And the reason why it does that is because it acknowledges the asymmetric effects of being away from the target. Namely, they're greater when you're below the target than when you are above. This is an asymmetry, unfortunately, that we have seen the effects of the hard way. And by having a higher inflation target, you probably manage that a lot better. So effectively, this is the Blanchard argument, where they say that you actually provide greater space for the interest rate to have space to move before landing at the zero lower bound. It's important, therefore, to maybe overshoot in the other direction. That's one argument in favor of changing the argument. But then, can you argue that the objective of price stability is better served if you have a higher target? And here, my view, and my take on this, is that the definition of price stability doesn't change if you change the target. We still we don't believe that price stability is now something different than, let's say, the working definition of 2%. The question is whether you are more effective in reaching the 2% by targeting something different. And I think that's only the spirit in which I would probably favor a change in the inflation target. But that necessarily implies the following, that you can no longer aim for 2% in the policy horizon. You need to aim for something higher and accept the fact that price stability is something that will be achieved in a longer horizon than 2 years. I think if you're going to accept an increase in the inflation target, you also need to accept a change of the mandate, if I may, which is that you won't achieve the 2% in the policy horizon, you can only achieve it at a longer horizon. All of this has to be defined, of course. You have to define what the longer policy horizon is, so you can have this communication and accountability of ECB, of central banks in general, ability to target price stability. But I think that's an important component of what a successful change of the inflation target would mean. And then comes, in my view, the most imminent of these problems is that, well, can we manage the transition? If we're going to change the inflation target, are we in a position to get there as a transition thing? The most obvious of criticism, of course, is that we haven't been able to get to 2%. Can we get into something higher? I think that, of course, is a very reasonable thing to worry about. But there I'd like to sort of take a step back and argue that the inflation target is not something written on stone. I have here a number of examples of how inflation targets have been evaluated, and that they're done both systematically, namely periodically, like in Canada, or they're done one-off. Even the ECB in the early 2003 did have another look at that part of the mandate and actually clarified what it meant to have what exactly was the numerical target that price stability was identified with, as well as clarifying the role of the second pillar. So I think that the transition is something that, if we believe that this is a good thing to do, we should actually do it. The transition should not really be a part of the problem. And here I have this data which I like to use. I have a number of countries that I'd like to show you. This is what I call the traditional inflation targeters. And the black line is inflation, and the gray lines, which are mostly horizontal lines, they are the bands within which inflation is being targeted in the countries. And when they are not straight, they're kinked, that means that there's been a change at that time indicated. And what's interesting about that is that you do see that a number of countries have actually experimented both with bandwidth, which is important for the tightness of the credibility of the target, as well as with the level of it, right? So you can see the bands that are changing, and countries, have actually used that as an instrument, actually, to gain expectations, to target the expectations and regain the credibility that is crucial for the effectiveness of monetary policy. If you go into a group of countries, I don't know that you can see them here, it's South Africa, Poland, Czech Republic, and Chile. And then on the right-hand side, you have Mexico, Brazil, Israel, and the Republic of Korea. These are countries that have adopted inflation targeting at some point in time. And there you see, these are countries with very high levels of inflation. And you see that they explicitly use the change of the inflation target as a way of reducing inflation, anchoring expectation, applying policy, reducing targets again, and therefore having a gradient way of reducing inflation. So the change of inflation targets is something that has been effective, has been done, and it is actually part of evaluating monetary policy in a number of different countries. So I don't think this is really a problem. The question is, and I think that's the one that it's important to answer here, is it effective in preventing us from landing on the zero lower bound and therefore avoiding the detrimental effects of deflation? I think that's the important thing. And the spirit in which I like to think about this question is, can we manage this uncertainty, which goes back to my original framework, of having to be in an era where monetary policy is not going to be as effective as we want it to be. Now, I have one more point. I don't know if I have the time, or you would like me to stop and come back?
No, let us keep that for the discussion afterwards.
Okay, no worries at all.
And thank you, Maria. Thank you. Let me give now the floor to our second speaker, Andrew.
Thank you, Peter. It's a real pleasure to be here. And I should point out before I start that these views are my own and not necessarily those of the BIS. And so the organizers set out some challenges for us on this panel, which is really to assess the fitness of current monetary policy frameworks. So not just monetary policy in the short run, but frameworks. So where should we be heading? And we have a number of questions, and you heard those questions. When I received the questions, it went through my mind that these are pretty familiar ones. And I was reminded of a time when I was in graduate school, and a number of the students and I sort of noticed that all the questions on the exams were the same from year to year. And we went up to this professor who subsequently became a Nobel Prize winner and told him this. And he says, well, that's not a problem because the questions always remain the same. It's just the answers that keep changing. And that's kind of a metaphor for our panel today. And it's a good time to start looking at these questions because in the past year and a half, the global recovery has really taken a turn for the better. The global recovery has broadened and deepened, maybe not so much in Europe, but it's been seen in other places where unemployment rates have come way down, and in some locales, the labor markets are actually tight. Investments picked up a bit, and so the private sector is taking a bigger leg in this part of the recovery. And inflation in most jurisdictions, not all, that inflation is moving into central bank targets. So we're getting towards the end. Maybe there's light at the end of the global economy tunnel, and we hope it's not an oncoming train, but it looks like it might be a positive outcome. So in my comments today, I want to sort of look into the past and then think about the future, and in particular, think about which way monetary policy frameworks are moving. This is the only chart I'm going to provide, but I want to make the following point, and for many of you it will be an obvious one. Prior to the global financial crisis, there was a trend towards narrow monetary policy frameworks, in particular inflation targeting type regimes, which would throw away a lot of the other mandates that central banks had been given in previous decades. Along with that, there was a lot of transparency, accountability, and credibility emphasis, and that was all very important. But the underlying philosophy was that if inflation was stable, and we can just get out of that 1970s kind of problem of high volatile inflation, the rest of the economy would follow. Well, the global financial crisis kind of burst that bubble to some extent. The post-global financial crisis period is a different sort of environment where we've gone through a tough 10 years and we're starting to swing back to broader policy frameworks. The type of frameworks I have in mind are encapsulated here, where we have our price stability and macro output stabilization, a pillar which is a financial stability pillar, and then a third one which is FX stability, which I won't talk about because I don't have time today, and it may not be that relevant for Europe, but it's relevant for a number of central banks around the world. So what are some of the lessons that got us to this point? And the first one is that inflation is not a sufficient statistic for stability. Prior to the global financial crisis, inflation around the world was incredibly stable. But in that environment, imbalances grew, and we saw them grow, and then they finally ended up crashing. Secondly, we found out that there is something called the financial cycle. Hyman Minsky wouldn't have been surprised with the kind of rhetoric we're using today, but he was certainly shunned in the decades before the global financial crisis. He talked about how there's this important link between the financial sector and the real economy. And we saw that in spades in the global financial crisis. He also said that there's a financial cycle. It's not just a one-off problem that arises from time to time, but there's this regular cycle in financial conditions, longer than the business cycle, endogenous, and often reflects sort of behaviors towards risk, enthusiasm, and pessimism. And that these things are not just a fluke, but it's part of our modern capitalist financial systems that are liberalized. And so with those lessons that I've learned, what does this imply about monetary policy frameworks going forward? First, certainly inflation is important, and we need to keep price stability in mind. It's paramount, and Governor Smets, mentioned that today. But also what we've done is we've realized that we have to keep our eyes on the financial sector and the imbalances that can grow. And that's often focused in on credit and housing prices, because those are the most extreme movements that we saw prior to 2008 and 2009, and the ones that led to the biggest problems. But the question is, well, we care about these things. We know inflation, that's in the purview of monetary policy. But we also have financial cycles. And that is something that responsibility can go into various parts of a government. And the question is, what is the comparative advantage that monetary authorities have there? And so the first question one has to ask in evaluating this is, do monetary authorities have a natural role in dealing with financial stability? And I think Maria touched on that with respect to credit. Credit is something that central bankers care about. It's something that's key to the financial cycle. So that's important, and we should keep that in mind. But that's not sufficient to say that the monetary authority should come in and act. The question is, what tools do we have? Well, we know we always had these microprudential tools which were aimed at keeping institutions safe, institution by institution, sometimes overlooking the broader perspective in terms of externalities that might lead to systemic problems or macro problems in the financial world. And now, since the crisis, we have a whole set of macroprudential tools, whether it's loan-to-value ratios, debt-to-income ratios, countercyclical capital buffers. And a lot of these tools are being used and implemented. But we have to ask ourselves, do we really want to trust these tools, which really haven't been tested for more than 10 years, if that? We haven't gone through a whole financial cycle. We don't know how well they're going to work. Secondly, we also know that there's already attempts to circumvent these kind of rules that have been put in place in a number of economies. And the ones I look at, you see housing prices continuing to go up, even if credit sort of slows down, increasing the risks that households may face some problems if there is ever another turn in housing prices. So these tools, while they're very important and we have to rely on them, they may be our first line of defense, but are they the last line of defense? And that's where we have to think about monetary policy, because monetary policy includes the use of the interest rate. And we often know about the interest rate as in economics as this intertemporal rate of substitution that affects your willingness to borrow and lend. It also can have an impact on wealth through the way that you discount future cash flows. But the third role it plays is the most important. It's the universal price of leverage. And it's these leverage cycles that are very painful, especially when they crash. And to the extent that interest rates play that role as the price of that leverage, you can use the interest rate to curb excesses in the financial system. But then there's one more question to determine whether the monetary authority should play a big role. It's whether the tools of the monetary authority are on the whole beneficial. And that's where most of the debate in recent years has been in this debate about leaning against the wind. There's one set of models that has been advocated by a prominent economist who argues that discretionary use of interest rates, you increase interest rates for, say, 4 or 8 quarters by 1 percentage point during a financial boom, will that have an effect on the probability of a crash? His answer, well, it's going to be small. But then he argues that the cost of leaning in terms of unemployment is very high. And I don't have a disagreement with that. In my own research, however, what I find is if you adopt a monetary policy framework that leans systematically over the financial cycle, that you get much larger gains. Now, I don't have time to go into the details, but I just want you to think about the 1970s. If you went to a central bank in the 1970s when you had high and variable inflation and you said, raise the interest rate by 1 percentage point for 4 quarters, would you achieve price stability? And everybody would say that's crazy. But adopt monetary policy frameworks focused on price stability, make that clear, and you have a fighting chance. And so this is the way I think about this debate about leaning, and I come to the conclusion that leaning should be a very serious consideration for monetary policy makers and when they're redesigning their frameworks for the 21st century. Now, if I have 1 minute, I don't, okay, then I was going to say something about inflation targets, but I'll wait to see if there's any questions. So thank you very much.
Okay, thank you, Andrew. Then we have now Natacha.
Thank you very much also for the invitation to this panel, which is actually my first conference since I started to work again as a central banker at the ECB, and I'm very happy about it, in particular because speaking about monetary policy beyond normalization is something that keeps us very busy in the Eurosystem right now. So we don't only do the monetary policy stance in the short term, but we think also about the framework that we're going to work with in the coming quarters for the transition years and perhaps even decades. So the set of questions that we were asked to look at was very broad, but the coordination was really good, so we sort of split the topics among ourselves. And so I will focus on something which is probably looks a bit more technical than the rest, because I'm going to look a bit at whether a big central bank balance sheet has to be with us for forever now. Will it stay in the toolkit of central banks for long, and what is at stake behind it? Now, before I speak about this, I want to say that all the thinking we can make about the long-term operational framework of monetary policy, basically the question is, in the previous world, before 2008, we had one instrument, it was the interest rate. We might have had others, we might have had different variations of operational targets, but basically the interest rate was the alpha and omega of monetary policy makers, which trickled down to all the modalities of what we call the operational framework, with the way we give the liquidity we create to the banking sector and the way we influence the way the banking sector is itself sort of creating money and transmitting our policy onto the economy. Now, the world is what it is right now, and we do have a toolkit which is manifold, much broader than what we could even dream of when the euro started 20 years ago. And you know, the pessimist would say we have to live with it. We have to live with it, this nasty starting point. And others would say, lucky we are. We got there by, you know, by the force of adverse circumstances, but now we have developed those instruments. And now maybe we'll have to see whether we want to keep them for longer. Now, it would be simple if it happened ceteris paribus in a world where, you know, our understanding of structural relationships would be sort of secure, would be known. The uncertainty would not change nature. But with the crisis, we have realized as well that many structural relationships have been redefined. And when I say many structural relationships, I have in mind the structure of the economy. We were speaking, and we'll speak again about the inflation target changing, yes, where, but no, where, to which level. Who knows today what is the optimal inflation rate? How do we know about the wage formation relationship? We are not even out of the crisis. It's probably a bit difficult, at least for us now, to even think about conceiving a discussion about the inflation target. So the structural relationships of the economy have changed. Because we have many instruments, the transmission of monetary policy has changed itself. So a second source of uncertainty, which we have to deal with. A lot of people are working on it, and we understand it always better. Mind you, the way to represent the reality is also new. We have new data sets, a lot more granular data. So we look at it from a different perspective. You know, before the crisis, there was a monopoly of macroeconomists over the analysis of monetary policy. Now you have to have big data scientists in monetary policy departments, because you have all that data that you need to be able to understand about the financial system and in fine about the way your monetary policy will be transmitted. So agents and policymakers have to learn the new relationships, have to learn the transmission of policies. And one key principle, I would say, in this process is really to know, to find the optimal monetary policy that is robust to those uncertainties. And the robustness of optimal monetary policy, it's an old concept, but I think it will come back to the front of the scene because of those multiple uncertainties we have to deal with. And this, it's not a purely theoretical discussion I'm making right now. And when I say a robust monetary policy, think about the latest Governing Council meeting. You come up with a conjunctural assessment. You have some doubts about the balance of risks. Now, ideally, you should be able to say, my monetary policy stance is robust, even if I have some doubts about the balance of risk around growth or around inflation, even if there are some uncertainties about my forecast. So that's all what it is about. So it's not only big or small balance sheet, it's about being robust about the choice that you're going to make in choosing those elements. Now, the good news I find is that central banks through the crisis have proved as creative as they could be, while remaining as conservative as they should. And I think this is really a balance. It's a bit of an oxymoron, but when you think about it, we really want a very long way. I mean, the colleagues who were with me at the ECB in the 2000, 2001, they would tell you how people were thinking at the time, and it's completely a different world. So the reason why this was made possible, and we'll come back to that when we discuss the objective and central bank independence, is that the central banks held to their fixed points, I think, which is first independence, and that's a thin line when you intervene massively in sovereign markets to say that you are managed to remain independent, and they stick to their mandates. So even if it might sound myopic, narrow-minded, we should care about many more things in the world, having a compass and making clear about what your objective is and showing to your constituencies that you're serious about achieving your objective. The objective might not be exactly the one that, but still that creates some stability in the environment and gives you a lot of power to act. And so a key lesson from the crisis in this unfolding of events and decisions to me, is the importance of the operational framework. And when we sum up the discussion to QE or not QE, a big balance sheet or not big balance sheet, I think we're missing about more or less the whole point of having around QE a whole set of instruments. And it's not only the matter, and I'll come back to that more concretely, but it's not about having a whole set of instruments, but about being able to use those instruments in a certain combination, under certain circumstances, to be able to have this combination evolving according to the circumstances. And this again maps into a very concrete sort of element of monetary policy making, When we speak about, the ECB decided in June, announced that it would, was considering to discontinue the asset purchase program at the end of the year, depending on data developments. There was a whole thinking as to whether having asset purchases in place was as powerful when you had at the same time reinvestments, when you had at the same time forward guidance, and what kind of forward guidance, and how do they interact? So when you think about that, you can also think about being clear about a sequence, being clear about what your cheminement will be from one instrument to the other, from concentrating on one, what we call marginal instrument to another marginal instrument, and getting a path which is not destabilizing towards a new normal, whatever the new normal might be. Now, this being said, a key thing for me is now the complementarities and the rotation across the monetary policy instruments. Now, there will be a question, and I will come back to that. We will come back to that probably on the interaction with governments and fiscal policy. But
you have still 1 minute.
Still 1 minute. So let me come to one slide. I have 10, but you will see them on the website probably. This is simply the chronology. I will show two, so I'll have 1.5 minutes. The chronology of elements that have been put in place. And you have 4 families of instruments. You could group them in different ways. But the blue one is rate cuts. So you see that they spread all the way through to what we think is the effective lower rate. So minus 0.4 was really difficult to get much more negative than that. Then you have 2 green boxes, and green boxes are one element of the quantitative policy, which is the supply of liquidity to the banking sector. Now, if I had to say, is APP more the most important factor in the implementation of quantitative monetary policies, I'm not so sure. At least I would say the supply of liquidity to the banking sector at a fixed rate and under full allotment procedure was extremely stabilizing and continues to be extremely stabilizing. Mind you, when you look at the chart that I will not show, but that you all know by heart, which is the size of the Eurosystem balance sheet decomposed into the components of the quantitative programs, excess liquidity stemming from what we call the TLTROs is quite massive. And actually, banks don't redeem that liquidity that easily. I mean, they have the freedom to do so, but they hold on to it, and there's a reason why. So those are the green boxes. And then you have the sort of pale orange boxes that are the private asset purchases, a bit more minor than the sovereign asset purchases, but they serve their purpose. And I think when we speak about the way forward, we should keep those in mind, because some have worked better than others, but it's not because some didn't work that well that they should be excluded, at least in principle. And then the bulk of it, obviously, are the steps around the asset purchase programs, mostly of sovereign debt instruments. And here you have the steps, the chronology of expanding and then withdrawing the program. So I think we should really have, and I will stop here because I'm short of time, although I would have had a lot to say, but at the end of the day, we could map a lot of those things into a level of interest rates. In a sense, the link between this overall liquidity that is provided by central banks right now and the way interest rates are formed will always remain the core of the thinking of central banks, in a way. So the new thing is that now central banks don't look only at the level of short-term rates. They look at yield curves. They look at term premia. They very much look at those things right now. And they might, they've got used to it, so now they will not. They will probably look at it for a long time. But it's really that link between the quantities and prices that will always be behind the thinking about the long-term operational framework. Thank you.
Okay, thank you, Natacha. And, last but not least, we have Anders with a concluding intervention before we have a discussion.
Okay, I would of course like to start with thanking the organizers for inviting me. I have learned a lot during the morning sessions, very educating for me, and this time of the day, it's hard to see if I can add anything to all interesting things that have already been said. We also have a very credible chairman, so I will make my 3 main points now at the start, and if I run out of time. The first point is that unconventional monetary policy, if we by that mean very low interest rates and big central bank balance sheets, is expected to be the new normal. The second point, one reason for this fact is that there are frictions in financial markets. And the third point is that if you believe that frictions in financial markets are important, then that also implies that the size and composition of the central bank's balance sheet will matter, but also that financial stability very well may be a goal for monetary policy, as Andrew has already talked about. So that was my 3 messages. So let's get back to the first. Unconventional monetary policy is expected to be the new normal. I have just 2 diagrams here. One shows market expectations of interest rates from the Fed, the Bank of England, and the Riksbank and the ECB. And the Fed is an exception, but if we look at the ECB, the Bank of England, and the Riksbank, the policy rate 3 years ahead is expected to be, say, around 1% or something like that. 3 years ahead, 1%. That means, of course, that we could very easily get back to 0 or even negative rates if there are negative shocks to the economy. The picture to the right shows the Riksbank's holdings of government bonds. It's not a forecast, it's not a promise, it just shows the implications if we don't make any discretionary decisions. If we only hold the government bonds we are now have until they mature, then it will take a long time to unwind the holdings of government bonds we have. I haven't seen similar pictures from the ECB. I think there may be one in Maria's set of graphs, and she may come back to that. Here are some pictures of different studies of the Fed's balance sheet, and the only point is to say that people find it fairly realistic that it may be a large balance sheet for the Fed even in the future. It may come down a little bit now, but then it's expected to grow again later on. So why is this? Well, we have discussed already this morning, and Eva Ortega talked about that, the decline in real interest rates globally, so I don't have to go into the reasons for that. But one point that I would like to make is that the global decline of real interest rates means that domestic conditions when it comes to, say, demography or technology really doesn't matter that much. We have increased openness, we have capital moving in the world, and that means that for a small open economy like Sweden, the real interest rate is probably likely to stay low for global reasons, no matter what the national conditions will be. And that, of course, is something that makes it hard for the central bank to have a high policy rate. We think that in general, globalization, increased capital mobility, financial innovations are sort of facts that are contributing to higher welfare in the economy. I think most economists believe that. But of course, the financial innovations and more integration and more capital mobility also involves new risks. We get new financial imperfections and there are new forms of risk-taking. And Raghuram Rajan pointed this out in his Jackson Hole speech in 2005, saying that financial development has made a lot of good contributions to increased welfare, but there are also new risks. And the second session today was very much about how do we balance this. There are good things coming with liberalization and capital movement, but there are also new risks, and how do we sort of balance these risks? But the implications of globalization, increased capital mobility, new risks, is that, well, policy rates are expected to be lower than before the financial crisis. Real interest rates have come down, inflation targets are low, so policy rates will also be low in the future and lower than before the financial crisis. And central bank balance sheets will also stay larger. And one may discuss various reasons for that, but simply I think that one may see the central bank as the bank for the banks. Central banks provide liquidity, and the need for a bank for the banks and the need for liquidity sort of has increased given the development of the financial system. So that is the reason I think that balance sheets will stay large. These are not new phenomena. We have had low real interest rates before, and balance sheets of central banks have been high before. So if we look at the left diagram here, it shows long-run real interest rates since the 1950s, and we can see that we had very strongly negative real interest rates in the 1960s and 1970s. At that time, policy rates were not low. They were around, say, 10% or something like that, but inflation was 15%. So real interest rates were low then, and even lower than they are now. So this is not a new phenomenon. Also, the size of the central bank's balance sheet, we often see the size is related to the size of GDP. But of course, the financial sector has grown faster than GDP. So if you relate the size of the central bank's balance sheet to the size of the financial sector, which is done in the right-hand picture here, you see that the size of the central bank in relation to the financial sector actually declined until the financial crisis. And the increase in the central bank's balance sheet in connection with the financial crisis has sort of brought the balance sheets back to something that used to be more normal. So my last slide, well, if we think that financial innovations also give rise to new financial frictions, well, that has implications for how we see policy. Well, if you don't believe that financial frictions are important, then it's sort of fairly logical to say that a short-run interest rate is the only important instrument for monetary policy. The size and composition of the central bank's balance sheet has no significant effects. It says asset holdings here, but liabilities also could matter or not matter. And if you don't believe in financial frictions, then financial stability should not be an objective for monetary policy. So these are sort of logically consistent views. If you don't believe in financial frictions, you don't believe in QE, you don't think that financial stability should be an objective for monetary policy, and you think that you can get back to normal where the short-run interest rate is the only important instrument for monetary policy. But if you do believe that financial frictions are important, then the central bank's balance sheet, its size and its composition matters, and it may be both a complement to and a substitute to sort of normal monetary policy changes in the short-term policy rate. And the same type of sort of assumption then about frictions also would lead you to the conclusion that I think Andy presented, that financial stability may very well be an objective for monetary policy. So those are also two logically consistent views if you do believe in financial frictions. Somewhat surprisingly, I think that the first assertion here that, yeah, there may be frictions and that may mean that the central bank's balance sheet matters, that is, I think, becoming less controversial now, but it's still very controversial that financial stability should be an objective for monetary policy, but I think those are sort of logically connected. The problem that some have touched upon already, and also Governor Smets talked about this morning in a very good speech, I think, is of course that if you do want monetary policy to pay attention to financial stability risks and you want to broaden the central bank's mandate, can the central bank then be as independent as it has been in recent decades? This is something that is discussed now in Sweden. We have a review of the Riksbank law. So any ideas you have about this would be much welcome.
Okay, thank you, Anders. Let me give now to the speakers a few minutes to comment upon the other interventions. Maria first, and perhaps let me also already throw in a question. You spoke about inflation targeting. To what extent could central banks aim for, let's say, an overshoot after an undershoot to have in the longer run a kind of 2% inflation objective?
Thank you very much, Peter, for the question. Perhaps I'd like to maybe pick on one point that we had on the issue of leaning against the wind. I think that's a very big. The BIS has been very, I would say, very actively researching on the issue, and most of the literature that came on this very novel issue has come actually from the BIS. So I think that's it's been a very important contribution to thinking us about this. I would like to sort of perhaps throw in a sort of a thought experiment, how we would have done, how would the world look different if back in the early 2000s we had actually followed this. And you know, it would be if you were to sort of make it concrete the way that you implement the leaning against the wind argument. And, you know, what type of variable would you have put in the objective function of the central bank? And there are different ways of thinking about this. But I mean, if the objective would have been to reduce credit growth, which is what was exorbitant in the early 2000s, we were 5, 6, 7%, 8% credit growth. And I remember we were all very puzzled how none of this actually showed up in inflation, because inflation was very well managed by simply controlling expectations, right? But so that means that the interest rate would have moved by a lot more than it did back then if the financial stability objective was also part of the central bank. And, you know, how would the world, what would have been different in this respect? And of course, you know, part of the answer normally, hopefully, would have been that some of these financial imbalances wouldn't have been quite so excessive, which is the good news. But on the real side, what would this have meant for the ability of the Eurozone to grow, and you know, where would be now if we had done that back then? And then I think that, you know, that's not an easy question to answer, and it depends a little bit whether you're risk averse or not. But you know, I would be a lot more in favor of this issue of coordination of instruments with for common objectives. There are two objectives in the economy, that's inflation and growth. And if you're conservative, it's just growth. Growth is really the ultimate objective. Financial stability is a way of achieving sustainable growth. So, you know, I'm really not, you know, despite the fact that I think that you've done a lot of very interesting arguments, and some of them is what Andres actually put forward, I'm still quite sort of leaning against the wind, if you know what I mean. And actually an important issue, and thank you, Andres, for raising this issue, is what would that mean for the independence of the central bank? Because I think that's something that if we were to lose, we would have been throwing away the baby together with the bathwater, and that would be, in my view, a big risk not worth taking. On the overshooting versus undershooting, yeah, that's actually the argument of those proponents of reducing the inflation target, is that you overshoot for a prolonged period of time to ensure that you avoid being in deflation periods. So if you take a sufficiently long, and that of course is a question what I mean by long here, a sufficiently long period of time, then you achieve price stability. Now, the details of this argument matter. I'm not going to deny that. But that's the logic of the argument, is that you can no longer aim for 2% in a 2-year period. You have to aim for more and then judge your ability to achieve the 2% in a longer period of time. That's the logic of the argument, but I do share your skepticism that the details of this matter.
Okay. Andrew?
I'd like to comment first on this issue of central bank tools, because maybe this is just semantics amongst us up here at the panel, but I think one needs to be somewhat circumspect about how to deal with QE and other related tools that have been adopted over the last 10 years. In the following sense, over the last 10 years, what we learned, not only the things I mentioned before about inflation and the financial cycle, is that in a crisis, central bankers will play a dominant role. And that role will be essential at the beginning. And what we saw in the last 10 years is over time, that role became more of an overburdened role where other policymakers didn't step up in the way maybe central banks would have liked to have a more equitable distribution of responsibilities for the 10-year, recovery process. And so in that respect, the way I look at it is a lot of these tools, they've been invented, they've been tried, some work better than others, but we need to put them back in the closet, way in the, behind glass, break only in terms of emergency. Otherwise, just stay away from them. And it goes to what Governor Smets talked about today, which is this inaction bias. And I would put into that also this risk bucket, the backtracking risk bucket, which We've been hearing lately that a number of regulators are starting to sort of backtrack a little bit from some of the tougher rules that were put in place over the recent past. And so how do I think about this? Well, we have inaction risk, we have backtracking risk, and we want to make sure that the public understands that the central bank's not there to offer bailout insurance. The central banks know this, but they have to be perfectly clear that they're not ready to step in at all times whenever any little blip comes. Other policymakers have responsibilities, and we'd like to see a nice balanced approach towards dealing with any of these financial stability risks. And so I would say that my distinction with my colleagues here is I would put these tools in the back and move back to more normal pre-GFC sort of policy tools, the interest rate being the dominant one for policy going forward. That might not, the only difference I would have in terms of that argument I just made, that's only for the first two pillars of my little building that I had up on the screen. The third pillar, which has to do with the financial, with the exchange rate stability, requires more balance sheet issues, but we're not talking about that today. In terms of Maria's question, what would have happened in the pre-2000 period, or post-2000, early 2000 period? I think you have to think about it in the same way we do about price stability. If a central bank and other regulators make it clear that they're not going to allow certain excesses to exist, well, that message gets out to the public, those who are taking on the risk. That message gets out to the regulators. They get the message that they should be looking more vigilantly. And it makes it clear that instead of the central bank being a cheerleader during times of low inflation and credit booms, they become the traditional institution that takes the punch bowl away from the party when it's just getting going. So let me leave it at that we wouldn't necessarily have higher interest rates in the early 2000s. We would just have better messages about what would be allowed and not allowed, and maybe that would affect risk preferences and behavior.
Okay, thank you, Andrew. Natacha, perhaps also, because no one touched actually on the boundaries between monetary and fiscal policy, and my question to you would be if the ECB would now be refinancing its balance sheet, its holdings of government bonds forever, wouldn't that be a kind of helicopter money? But okay.
Nobody ever tried helicopter money, even the strongest proponent of it. I'll come to that, but I wanted to react on the financial stability monetary policy, and I would concur a bit with what has been said. I mean, take the world as it is right now. Now we do have macro-prudential policy tools. We do have instances that are able to actually implement those concrete policy decisions. And so let's see how they do their job, and don't preempt on whether what happens if they don't do it well or what happens if so we have worked for years during the crisis in adverse time to construct those things, and presumably hopefully they will work. But the first best to me, given the current state of the world, is to sort of allocate the tasks according to what institutions were set for. Now, this being said, there are always interactions. I mean, it's a general equilibrium thing between monetary policy and financial stability policies. And one very concrete small example, when you think about how we'll implement monetary policy in the future, one big topical discussion is whether we will continue to operate under what we call a floor system or a corridor system. Now, if you remember, before the crisis, we were speaking about the corridor of interest rates. And so the policy rates, plural, were adjusted, and basically market interest rates were guided by a very fine control over the liquidity quantity that was circulated in the banking system. So every day the central bank had to forecast so-called autonomous factors, how fast banknotes are growing, what are the needs coming from what governments deposit at the central bank and the likes. And so we came up with a number which was meant to be the neutral liquidity position of the banking system, to which the central bank was supplying the quantity of money that was necessary to keep interest rates at a given level. Now, we are not in that world anymore. Now we have a floor system, so the central bank gives market whatever they want in terms of liquidity, and the interest rate is basically guided by the lowest of the policy rates, which happen to be the rate at which deposits at the central bank are remunerated. So that's why interest rate on excess reserves have become a key policy tool in a sense. Now, if we wanted to get back to the old system of having a corridor and controlling very finely the liquidity, the quantity of liquidity that central banks need to put on the market to make the banking system, at equilibrium, then we would certainly not be able to return to the old times. For one, among other reasons, one of them is the fact that banks need more liquidity for inter alia regulatory purposes. And in some cases, if those counter-cyclical measures are implemented, the banking system might at times need even more liquidity or a bit less. So it fits back onto our sort of choice space in terms of how to implement monetary policy. That's not an issue at all, but that is a fact of life. And in a sense, on the question, big balance sheets for central banks, they will have to be bigger anyway, to some extent. Not only because you have, banknotes in circulation growing fast, but also because of those elements that pertain in fine to financial stability. So those things are really closely intricated. Now, on the link between monetary policy and fiscal, it was really a taboo before implementing, purchases by the central bank of sovereign paper in the secondary market, and that we moved over the initial sort of narrow interpretation of the treaty, and in particular on the prohibition of monetary financing that is embedded in the treaty. And that's probably a good thing that we were able to do that. This being said, when we think about the quantity of those assets that sit on the balance sheet of central banks, it also means that those central banks, not because they are central banks, but because they are asset managers, in a sense, do hold a responsibility for the way those sovereign markets work today and will work in the future, and also the way the transition will be managed will also have an impact on the way sovereigns will be able to issue debt, on the pricing of that debt. And that was, by the way, one of the key transmissions that we were looking for during the crisis. So we have to keep that in mind, because even if we don't necessarily have to enter questions of independence, and we're not there anymore in the advanced economies. We are not at a point where we are asking the central banks to print money to finance government debt. Yet those things are very intricate, and even if you don't think about those two balance sheets are being consolidated, you have to know that in the balance sheet of the central banks today, there's a lot of liabilities that have been issued by the sovereign sector. And the best way to look at it is probably to think about the sovereign sector as being an issuer of an asset, which we collectively thought or will think is as close as possible as it gets to a safe asset. But the world is not perfect, and we have to take this into account for risk management purposes, but also simply for asset liability management in the central banking sense, which is a bit different.
Okay, Anders?
Oh, I want to pick up on something that Maria asked. Your question was, what would have happened if central banks had leaned against the wind earlier? And of course, we don't know that. But there was a discussion before the financial crisis whether central banks should worry about the rapid credit growth and the growth in house prices and so on. And at that time, the central banks did not say that yes, we are worried, but we can't do anything about it because it would threaten our inflation targets. That's not what they said. They said basically, we don't see big risks. So I think that if there had been more of sort of close monitoring of financial stability risks before the crisis, then maybe central banks would have tried to do something with monetary policy. That would probably not have prevented the financial crisis, but it may very well have led to a smaller crisis than we experienced. I don't think that financial stability concerns should replace inflation targeting. I think price stability should still be the primary target, but if we can talk about output and employment as sort of a dual mandates for monetary policy, price stability and real stability, then I don't see why we cannot talk about triple mandates where the primary target is still price stability, but the central bank should do what it can to contribute to say real stability and financial stability.
Okay, thank you, Anders. We have still, for the sake of time, we have still 5 minutes for questions. So keep your question very short. Very short.
I have very short questions. Who of the panel members, and that is including our chairman today, issued a strong, clear warning against the financial crisis before June 2007? And then Mr. Vredin, you made remarks about QE. My question is very simple, very short. Who believes in QE? Or in other words, who believes it's good to save reckless financial institutions and governments and punish the good, prudent sheep with money in their savings accounts? Thank you.
Okay, other questions? Yeah, let's before we do all the green.
Thank you. Lars Holgaard, formerly with the Commission, now with Trade Up. Interest rates are an indication of the price of money. Interest rates are low. Why are they low? Because there's a surplus in savings. There's a structural surplus in savings. Apparently there's not enough demand out there for investments together with consumption. So isn't there something here that needs to be addressed in terms of the structural deficit in demand in relation to the price of money? Thank you.
Okay, last question, perhaps. Yeah, over there.
Thank you very much. Klausina from the German Insurance Association. I have a question on financial stability versus price stability. And if monetary policy cares a lot about price stability and not so much about financial stability at this point in time, do you think that it's a good idea if the head of the ECB is also head of the ESRB? Or, put differently, should we not have a financial stability board which is totally independent from monetary policy in order to address the issues of financial stability if monetary policy is geared so much towards price stability?
Okay, we have a number of questions. Maria, you go first.
Maybe on the last question, because I think that of course has a lot of logic in it. If you wanted to have an independent institution where the logic is independence from political motives, then of course that is always welcome, just as it was welcome in the monetary policy. Monetary policy is of course part of a political cycle, whereas the financial stability is the financial cycle is longer than that. So you could actually, there is one step removed. But I think there is a difficulty with creating such an institution, and the reason for that is because the instruments, they are spread. So you could think about housing policy, you could think about taxing policy, you could think about regulating the balance sheet of banks, or the decision-making of banks. All of these are components that manage financial stability. So if you were to create a financial stability board equivalent, you would be taking away policies that are so linked to the welfare of the economy. Think of housing policy, for example. And I'm not sure that these types of decisions need to be independent of the political cycle, because they reflect welfare. They have very specific welfare implications. In my view, they're very important. So, you know, would you take housing policy away from the political institutions, from the ministries, in other words? I think there are issues there. So I think there is a difficulty with doing that. May I show one graph, because I wanted to, if I may, can I put back my slides? I just want to show one graph. Just on the, I just want to show this graph because I think it's an important graph for this one. So this is an estimate, and it comes down also a little bit to Lars' point. This is an estimate of the neutral interest rate, right? And you know, you can be forgiven for thinking that there is a trend here. And that trend means that we are going to have to deal with an environment in which the interest rate, the instrument, will be very low for a long time. So that means that we are running out of degrees of freedom here. What are the instruments that we're going to have in our hands, or central banks will have in their hands, to manage their objectives? Now, if on top of that you're asking the central bank to target financial stability and to do it in this low interest rate environment, I don't know how effective this monetary policy is going to look like in the future. So, you know, and here I agree with what Natacha says. If we need more instruments, and you know, let's see what the current instruments that we are experimenting, if you like, with will deliver, because I think that the main interest rate of monetary policy is going to be constrained for some time to come.
We got the question from the gentleman in the green hat, who of us had warned about the crisis before it happened, and I can say that I certainly did not. And I read Rajan's contribution to Jackson Hole 2005, unfortunately after the crisis. But that's why I pointed it out. I think we should go back and see, how did people think that warned us before the crisis? Rajan did so, some people at the BIS did so. So I think that going back to the people who really pointed this out before it happened, there I think we can learn a lot.
Other reactions?
Yeah, maybe on this link between, basically what we were speaking about is really a link between the financial cycle and the business cycle. And if the central bank is not, you know, caring about financial stability as a primary mandate, because it cares about the business cycle, and as far as the financial cycle affects the business cycle, then it does care as well about the financial cycle itself. So through that channel, you can already go a long way, and we still don't know, because the ways in which the financial cycle affects the business cycle are still to be understood. I mean, and that was a big contribution by the BIS to make it as a sort of standard framework for us to think about it. But that's, I mean, I think we should be fairly modest about it. Yeah.
For the sake of time, we're already running 5 minutes over schema. I had a very difficult task to be timekeeper of 4 economists, but they were wonderful economists, and let's give them a big hand for their valuable contributions.